Hi, good morning, everybody. Welcome to today's webinar. So today we'll have the US weekly, the China weekly, the Singapore, followed by the technical analysis. So firstly, for the US weekly, for the past 1 month, you can see that most of the sectors return in the green, whereas for the past 1 week, we can see that there's a short correction for most of the sectors, but this is mainly because of uncertainty of the trade war. And even though during the G20 meeting, both US and China decided on truce, but because of the fundamental differences between the two countries, we think that it is very likely that the truce may break down, and additional tariffs will be levied on the rest of the China imports. So today I'll share on two stocks. One is Amazon and the other is Eli Lily. So for Amazon, we are positive because they show great strength in their engagement and for their cloud offerings and their ability to simply just disrupt industries by leveraging on their new technologies. So there are three key drivers for their growth. The first will be the expansion into the grocery and pharmacy market. We think that this is one of the most important for them to re-accelerate their growth. So assuming that the current trend of the 3% annual growth for the grocery spending continues, then the additional TAM, which is the total addressable market, will be close to 700 billion. Pharmacies will add another 200 billion to their revenue in 2019. As for Amazon Web Services, it is one of the largest cloud service providers, and their revenue year on year has been more than 40% for the past quarters. Sorry about that. Could you check whether you are seeing the actual presentation right now? All right, thank you. Okay, so I'll continue. So for Amazon Web Services, we think that because the cloud market will grow at about 40% CAGR to reach about 280 billion, we are very positive on AWS. And their newly launched AWS Outpost is likely to be a differentiation factor from its competitors because of the fact that it has deep domain expertise and the ability to bridge legacy systems with their cloud service platforms. The last key driver will be advertising. One key differentiation point of Amazon as compared to its competitors such as Facebook and Google is the fact that it has actual purchase data from its customers. So that will allow Amazon to leverage on this data to train their machine learning and to better tailor their advertising towards the customers. The next company that we're going to talk about will be Eli Lily Company. So this is a pharmaceutical, and some of the key blockbuster drug classes that are for them is endocrinology, which is to treat diabetes. Currently, they are also focusing on oncology, which is the treatment for cancer. So there are two main key drivers for Eli Lilly. We are positive on Eli Lilly because of its upside potential due to its strong volume uptake for its blockbuster drugs, mainly for diabetes. We also see meaningful late-stage drug pipelines. And because their valuation is currently quite reasonable as compared to its peers, it's currently trading at 22.4 times earnings, which is lower than the historical average. So for the first key driver would be the strong uptake in the core drug categories. So for the diabetes drugs, Trulicity and Jardiance, they continue to perform well, despite the fact that there is increasing competition. For Trulicity, it's able to defend its market share of 45% for the diabetes market. Whereas for Jardiance, there's continued strong uptake because of the re-inclusion of the product on the CVS formulary. So both have seen more than 100% year-on-year growth for the past 8 quarters. As for Taltz, which is an immunology drug, it is used to treat RFDs. It has increased by more than 150% for the past 4 quarters as well. We also see various healthy late-stage pipelines for diabetes, pancreatic, and lung cancer as well. So this is the upcoming earnings release, and the banks, as usual, will be the first to showcase their earnings results for Q2. And with that, I'll pass on my time to Jie-Yuan.
Thanks, Edmund. For China last week, on last Friday's the U.S. and the China's presidents meet at Japan's. From both the sides, the Trump and the Xi agreed to restart the U.S. and China trade talk. For the key principles, this one will be going, and on these negotiations, the U.S. won't add more tariff to the Chinese goods. But we continue to think that these trade talks will last for long because of the key topic of this trade war. The first one is they will reach the new trade agreement because from the U.S. side, U.S. want China to purchase the more than 300 billion USD American purchase goods from the U.S. sites is almost doubles is more than doubles for the current purchase size of the China's. And the U.S. didn't say about how they are going to do with the current tariff levels. So we are thinking the new trade agreements will be this negotiation will last for long. Also, the U.S. didn't remove the Huawei from its sanction list. We are thinking the technology industries, the negotiation and the financial market open up will also last for long. Based on this, the background, we think that currently there's two investment opportunities for the China-Asia market. For the short term, we look at the price corrections because of the restart of the trade war. We can see there's a big gaps. We compare the year-to-date performance of the May and year-to-date performance of the June. We are seeing there is the big gaps on the communication industries, also the energy industries. Because of the we're thinking the Huawei is still in the sanction list of the US. We're thinking maybe there is a price corrections happens in the energy industries. For the long term, because of we think the trade talks will last for long. For investing in China's the market, we're thinking we should be looking for the industries with the revenue guarantees and the focus on the local demand, because from the January to May, the local demands of the China side still being strong. We are positive on the financial sectors and the consumer sectors. For the financial sectors, it is because of the 2019 is the government main focus is on the financial market reform and open up, also to do the supply side reforms. It will give the business for companies like the banking and the brokerage companies. For this week, we are waiting for the Caixin China's the PMI to see the confidence levels of the small and medium-sized business, small and medium-sized China business. For the corporate recommendations, we are highly positive on the China banking sectors, and we like for the stock pick, we like the Ping An banks and the China merchandise banks. For Ping An banks, we are seeing the Q1 Q1 2019 the net profit is up about 3%, 30% year on year. Also with the low non-performance loan ratios and the highly coverage for non-performing ratios, we are thinking there is a buffer futures the revenues. For China merchandise banks, we like this because of this core tiers to 1 ratio still went up about 41 basis points to in the historical high levels. It will provide the guarantees, provides the more rooms for future rooms. For the target price and enterprise, I will leave to the William for technical analysis. I will pass for Paul for Singapore Weekly.
Thanks, Jen. I'll just move on to Philip. That's our usual weekly update. For Singapore, in terms of the macro, we are still in a deceleration mode. I think the industrial production came out recently. It was down almost 2%. Just to give you some context, in the first quarter, it contracted less than 1%. Now it's contracting 2%. So there's some acceleration. I think worst hit is the electronic sector. I think it's down almost 11% for May, whereas it was already contracting, but the contraction is accelerating. Inflation numbers, nothing much. Just so long as within the MAS 1 to 2%, there'll be probably no aggressive moves by MAS on the foreign exchange. In terms of in terms of banking sector, next week, meaning will give you more details. But the loans actually just grew modestly better, so that's positive news. In terms of the US macro, the underlying theme is that consumer spending is holding well, but I think corporate capex, as expected, is actually starting to decelerate. Global macros, obviously, even in Europe, we see very record government bond yields. I think the German bond yields are record lows, all-time lows, and also some data points that came out from Germany also still continues to see that the German economy is decelerating. In terms of our I will show you some charts later, but in terms of our tactical views, as you know, the last 1 month, we just got a huge re-rating on almost all asset classes because of lower interest rates. And the market is rallying because we're getting this backstop. The weaker the economy, the lower the interest rates, and also we're getting some China stimulus. And also the market is just rallying as interest rates have actually technically kind of peaked in the near term. But we're still looking at some sideways movement because economic conditions are still somewhat sluggish. But Singapore dividend yields probably will stand out, especially among the developed markets. After the large rally in all these purely yield stocks, especially for the REITs, we're still looking for stocks that have some dividends, but also there's some growth behind it. So on a relative basis, I think banks kind of stand out. Banks have maybe 4 to 5% kind of dividend yields, and then you're looking at high single-digit growth. And in terms of the operating conditions, I mean, SIBOR is, despite the contraction in most government bond yields, the SIBOR is actually quite stable. Loans is kind of stable too. And also with government bond yields are plunging, you're actually going to get some kicker, at least on their trading income for some of these banks. So that could be some boost to the second quarter earnings. Trade deal, nothing much is beating expectations. And the thing to watch out for is, I think by today, just another snapshot of how economic conditions are happening globally. And of course, we got the payroll numbers on the 5th of July. Just some quick shots. You can see from this chart here, as usual, the industrial production for Singapore is quite bad, especially for electronics, continues to contract to several-year lows. Then banking loans are kind of stable. I guess this chart is the one that has helped the global markets. You can see this is just a proxy for all the global 10-year bonds for all the major markets, US, Japan, and Europe, and Australia, and so forth. You can see that it's contracting back to almost all-time lows that we had in I think this is the post-Brexit low. So actually, global yields are going to, there's a chance that it could probably go below even the post-Brexit lows. And likewise for all these developed countries. In terms of economic conditions, it's still pretty weak out of Germany, out of US. Only consumer demand picking up, and even China came out with the PMI on Sunday. I mean, it was within expectations, not expected to rebound, but I guess the contraction wasn't as bad as everyone kind of expected. Okay, this is the last slide. This is our Phillip Absolute 10, and as you know, this is our model portfolio. We will probably move it every quarter, so probably the next 1-2 weeks we'll probably do some changes. What has done well has been our yield stocks. Most of the yield stocks have done really well, and also the telecommunications have actually done well. Pulling us down as we put in some cyclicality into the portfolio has been the one that's hurting us. So we might do some changes to that. So year to date, at least it's up about 14%. Okay, I'll move on to Wei Ren on the technicals.
Thank you, Paul. Right now we're going to share on 3 technical views. Mainly Eli Lily and Co. China Merchant Bank listed in Shanghai Stock Exchange, and lastly the STI. Okay, so for Eli Lily and Co. Currently we are in the minor phase of the wave count. So currently we are at the fourth wave correction. And based on the 4th wave correction over here, we can see there's a falling wedge. So it signifies a bullish reversal pattern. However, we are seeing the rebound at 106.289. It may have a false breakout of the falling wedge. And then subsequently it will rebound, and then the long-term target price is at $140. So why do we say that this we will have a rebound here? Because if we look at the corrective wave at wave 2, it has a series of running flats. So it's a very complex correction. So classic Elliott wave rule states that if wave 2 is a complex, correction, and wave 4 therefore will be a much simpler correction. So let's move on. So as I say, falling wedge suggests stock may head for rebound soon, and also stochastic shows oversold crosses in the oversold zone. However, there is a possible or invalidation of the minor wave count is that should the stock price fall below the threshold of 50% of wave 3, which is 102.91, and close below it, then therefore the whole LLY wave count will be invalidated. So let's move on to the China Merchant Bank. Our view is that China Merchant Bank in the weekly time frame is that there will be a short-term bearish correction as we have a weak breakout of new high in 15 April and 17 June 2019. However, the stock went to a tight consolidation by forming a rising wedge. Like previously, we talked about the falling wedge, which is a bullish reversal pattern, but for a rising wedge, is a bearish reversal pattern. So and plus the RSI flat top and the rising trend over here suggests that price is going losing momentum in the bullish momentum, and therefore we will be seeing a bearish correction. So however, the dominant trend is still bullish as price are trending above the 3 major moving average, the 22 simple moving average, 50 and 200 SMA. So however, if you look at the 61.8 Fibonacci retracement level, which is over here, the 50 SMA is at the confluence point. So therefore, we are seeing a strong buying pressure at this potential buying area. So for Straits Times Index, there's some update, unexpected update due to the new positive news happening in G20. We're seeing the STI grew by 0.6% as of today, this morning at 12. But however, our view still our bearish correction view is still remains as because first target the price has to break through a 3,400 psychological level and close 2 candles above to consider that the whole count is invalid. And secondly, the pro gap zone price is still moving around at the pro gap zone in the weekly pro gap zone. So should it break 3,004, then we are seeing a downside. Next, based on the LLY wave count now we are currently at a minor wave count of the weekly chart. So wave 2 target price will be at here. So once price actually in the long run price reach 2006 price region, then we will be seeing a strong bull rally here. But right now, currently we may be in the consolidation zone, and therefore any strong buying any strong long desire is avoided. So the daily chart, although the daily chart show bearish divergence, but however this morning open, it totally invalidated this whole analysis in the daily chart over here. So this end of our session. Is there any question? VCOM, I did share VCOM on the our stock BNB on the technical power section. Currently VCOM has a ascending triangle, so we are aiming for a breakout of the ascending triangle. So in the short run, VCOM is in a bullish sentiment. Thank you. There shouldn't be any issue on the low trading volume. Thank you. Hi Vincent. Just now I went back and checked the price. Currently VCOM has already gapped up and broke out of the triangle, ascending triangle. So just try to watch price. If the price do break $7 psychological level. Thank you.
Hi, there's a question regarding problems in Hong Kong leading to potential loss of confidence and if there's any benefit for SGX. So to give some brief color on SGX, around 50% of the revenue comes from securities, and the other percentage, majority percentage, come from derivatives. So within the securities, listing revenue isn't exactly a very high proportion. So for IPOs listed in Singapore, majority of the revenue that SGX get is from the recurring yearly fees that they charge IPO companies, listed companies. So with problems in Hong Kong, there might be a certain upside for SGX, but given that around 50% of SGX companies are from other countries other than Singapore, it may not exactly mean that SGX will see a huge upside just because there are some problems in Hong Kong. There may be some upside, but it's not going to be material. Whereas for SGX, the positive things that we are going to see is the derivatives volume. It will usually spike up during times of volatility. So that is the place to look at right now for SGX. And that's why it's in our Phillip top 10 as well, because it usually performs well when there's trade war volatility or interest rate issues here.
PM China's the main business is insurance, also is listed on Hong Kong's. We are recommended the banking sectors, so I recommend the PM Bank list on the China. Also,
hi, we have a question. How is the economic indicators? I think in general everything is still sliding, but I mean economically most data points are still sliding. Maybe apart from the US. But globally, most things are sliding. Probably for Singapore alone, our GDP first quarter was 1.2. It's probably going to get worse in the second quarter. Yeah, that's just a general sense of what's happening. Yeah.
Hi, there is a question asking about the update relating to the oil price movement. So right now, Brent and WTI are hovering around $60 to $70 per barrel. So we think that in the second half of this year, the price level will be still trading at the current level, because right now OPEC and Russia are considering to extend the output cut for another 6 months to first quarter of 2020. So in the second half of this year, we think that the supply and demand dynamic will remain the same at the current level. Thanks.
Hi, so we have a question for about current read outlooks for hospitality sector. For the hospitality sector, the RevPARs are actually slightly lower year on year, about 1.6%, and the average room rates are flat. There is new supply coming on into the market, but that's mainly isolated to Sentosa area, so it doesn't really affect the rest of the hotels. So we expect the outlook for hospitality to be a bit weaker than expected due to the lower international tourist arrivals. Thank you.
If there's no more other questions, we'll end our webinar today. Thank you for tuning in. Bye-bye.